This is Rudy for Bester Investor or Mr. Oxy. What we're going to do today is take a quick look at Occidental's wall of debt and put it into little quotation marks because anytime you see a wall of debt, you know it's Wall Street speak. So let's take a closer look at this and see what's going on with Occidental's debt. So first off, news. As of right now, breaking news. Shares of several oil companies, energy companies, are trading higher as storms approach the Gulf of Mexico. They've forced producers to shut down production in the area. Strength is also potentially related to macro factors amidst slowing US coronavirus cases and treatment optimism. Well, I guess that would be true of the entire market from a macro point of view. How much that impacts the actual market in terms of people buying and selling stocks is debatable, but hey, if that's what the news says, then that's what it is. This is as of August the 24th, which is today, published at 1:48 Eastern Time, so about 2 o'clock New York time. So the reason why I made this video is because one of my followers, Yidi Zhang, sent me a note, and Yidi said, will you do a video about how Oxy will be able to pay back its debt due in 2021 and 22, and a breakdown of the calculations would be appreciated. So I'm going to go a little bit beyond that to 2024, just because that's some of the insight that we have that was provided on the Q2 earnings call with the CEO and some of the staffers, including the CFO. So let's look at the debt summary to begin with. Firstly, I want to just sketch a little bit of a background. The recent asset sale was at a great price, 1.3 billion. Anyone who says or argues to the contrary is highly debatable. If anyone says it wasn't a good deal, ask them to qualify why it wasn't a good deal, and you'll find that they'll stumble a little bit, or otherwise refer to something that they saw on CNBC News or something like that. Oxy can comfortably manage to pay its debt, and that's not even counting the massive asset sales. I'm going to get more into that in just a second. And Oxy is going to reward its shareholders going forward. That's despite its debt-based enterprise value. So just a couple of minutes ago, I quickly looked at Oxy on the market, and I saw Oxy was trading up about 2% today. I'm not a day trader, but I do pay attention. I look all the time. It's nice to see Oxy getting a little bit of an uptick, which obviously could be related to the factors I mentioned on the previous slide. All right, let's look at this land sale that Oxy has just announced a few days ago. Oxy sold 4.5 million mineral acres and 1 million surface acres to Orion Land Finance for $1.33 billion. Oxy can obviously use this cash to pay back debt with roughly the same yield and a net neutral free cash flow. That's quite important. Let's take a look down here in the fine print. In their announcement, it said they had entered into a purchase and sale agreement to divest the Wyoming, Colorado, and Utah land grant assets to Orion Land Finance. The transaction, which is expected to close in the fourth quarter of 2020, has a footprint of approximately blah blah blah. I just set that up above. But here's the thing: Oxy will retain all cash flow from current producing oil and gas properties on the position, which are primarily cost-free royalties. What a beautiful deal! A little bit more. The land sale obviously helped, but let's take a look at some of these things. So in the second quarter conference call, we saw that they were taking some steps to reduce their near-term maturities. The main thing that's important here is everybody talks about Warren Buffett's 8% coupon on his preferred. The fact is, if you take Oxy's debt and you calculate the weighted average interest rate on all the debt, it's 4.2, which is actually reasonable. There's nothing too extraordinary about that. But this is even more important on the right-hand side, this section over here. The expected liquidity to address near-term maturities. 2 billion plus in asset sales. We just talked about 1.33 a minute ago. free cash flow generation in the second half of 2020 at the current strip price. $1.1 billion cash on the balance sheet. This was as of the end of Q2. They've got more cash than that by now. And a $5 billion credit facility, which is undrawn and fully available. So OXY actually has quite a bit of cash. $5 billion in an undrawn facility if they needed to, plus $1 billion plus in the bank account. That's about $6. They've got some free cash flow generation, especially at $40 WTI right now, and $2 billion generated from asset sales. So if you add all that up, you got, $8-10 billion worth of cash flow in terms of the debt that they need to service. And we're looking specifically at the near-term debt of 21 and 22, but we're going to look a little further ahead to 2024. 2021 excess cash after dividend. So right now, what we have is a break-even maintained at $40 WTI, which is West Texas Intermediate, with a $3.9 billion sustaining capex. Highly leveraged to the oil price to generate significant excess cash. At greater than $50 WTI, production growth of 5% and capex of $6.6 billion. At less than 50, production and capex will be moderated to stay within the current limits. This is not a bad picture at all. I think you have to be very bold to predict that the oil price is going to crash again and go negative from where it is right now. Obviously, it can dip, but I don't think we're going back down into the 20s. It's very likely we'll see 60 before we see 20. So in closing, OXY is currently consuming approximately $4.6 billion in annual cash flow at $40 West Texas Intermediate. Assuming $40 and not less, OXY has 4 years to 2024, during which OXY will generate approximately $18.4 billion in annual cash, and it needs to service debt of approximately $12.5 billion. Get it? OXY, I'm going to say this again, in the next 4 years will generate approximately $18.4 billion in cash flow to service $12.5 billion in debt. But it's important to note that during the next few years, it will be more about OXY improving its financial position versus shareholder rewards. But that doesn't mean investing now is a poor decision for investors who are willing to take a risk on an undervalued stock. If you're still watching this video right now, I think we can agree that Occidental is an undervalued stock. Summary: OXY realized a great multiple on its recent asset sales. The asset sales on its own are not illustrative of OXY's ability to comfortably handle its debt. We talked about that. They have more than $1 billion in the bank. They have $5 billion of an undrawn facility available if they need it. And they're generating significant free cash flow at $40 or more on WTI per barrel. OXY is currently enjoying strong cash flow. I just said that. Of course, there are some oil price risks that investors need to pay attention to. But overall, in my opinion, the risk-reward balance favors investors hunting for an undervalued stock right now. And Occidental is an undervalued stock. So guys, that's a wrap for today. I talked a little bit about the debt. I was more concerned about Occidental's debt in Q1 and even going into Q2 because I was unsure what was going to happen because of the shutdown as a result of the coronavirus, which was exacerbated by the crash in the oil price. I'm much more comfortable today, and in fact, I've been adding to my Occidental position. So that's a wrap for today. This is Rudy for Bester Investor, or otherwise, if you want, you can call me Mr. Oxy. Signing off and saying keep well, stay safe, and thanks for watching. Bye-bye.